one of Trump's biggest promises that he made when he came into power was that he was going to change their economic deficit.
There has to be a level of commitment. You have to be committed to meet with a financial advisor, meet with a mortgage broker, and then potentially talk to a buyer's agent. Probably a month's worth of work. The biggest thing that has on Australia is they're our biggest exporters of coal or minerals from Australia.
The direct impacts on Australia have been limited.
It makes sense why a stable, tangible asset like property is a safe. What does it mean for the next four years that Trump's in office?
I remember seeing years ago a bit of a chart, and when markets are crashing, that's when people panic sell.
Property's always been one of those things where it's just a stable investment and a tangible asset for people, and there's 95% of Australians don't have exposure to residential real estate in their superannuation fund, so there's a big opportunity there.
You also need to accept that it's going to cost you money to make money.
Yeah.
All these things need to be set up. You're paying for all these people's time, which is then going to create you a lot of wealth.
Yeah.
You're bitching and whinging about $10,000 now. I bet you're not bitching and whinging about the $1.5 million extra you're getting in 17 years.
Yeah.
Welcome back to Talk Property to Me. My name is Brad East.
I'm Aaron Downie, and today we've got Trump's tariffs, property and self-managed super fund opportunities in the market.
What I'm also going to talk about at the end is what the latest is on rate cut predictions and what that actually means to the listeners, I guess, on a dollar value and what that interest rate might look like early next year. So some exciting news.
An economic lever.
100%. So as people would know, Trump has been using tariffs in America at the moment as a bit of a leverage tool to enter into trade agreements with majority of the world. A little bit of background on that. Basically, one of Trump's biggest promises that he made when he came into power was that he was going to change their economic deficit into a surplus. So basically meaning they're exporting more than they're importing. Currently at the moment, they are in a negative, and they are in a negative with a lot of countries. So this was one of his tools to really fight that. I don't particularly agree with the way he's done that. It's quite aggressive and throwing tariffs on anyone and crashing stock markets and all that sort of shit. But do you expect anything else from Trump? Seriously?
Well, you can see the power that he has on the global markets.
Yeah. And there was talk that he should be fined for insider trading and all these things. I'm staying out of that. I don't agree with what he's done, but at the same time, what we're talking about today is what effect they have had on Australia and what we think that looks like in the future as well.
Yeah. So as a high-level overview, and I'm sure most people have seen it on the news, 10% on Australian exports to the US.
Yep.
145% on Chinese goods.
Yep.
But as we're all aware, there's a 90-day pause, and I'm sure he's working out another strategy moving forward.
So that 90 days is all except China, I believe, because they just started comparing dick sizes. Yeah, I did this, you do that, and it was just this backwards and forwards, and so the way I interpret it is the 90 days is to allow some decent negotiations and agreements to be sought.
Yeah, what a good bloke.
Yeah, so nice. Put a gun to your head, and then give you 90 days to make a decision. So that's Trump for you. But based on what has happened so far, what we know so far is that the direct impacts on Australia have been limited. So that's a direct impact. Indirect effects are mostly things that are affecting China and Japan. But what I've seen recently is a lot of e-commerce stores that are Australian owned, that their biggest market is America, but the goods that they're selling are created or built in China, and then they're shipping from China to America. All of a sudden, there's 145% tariff on these goods.
Yeah,
So,
and that's the thing. We're operating in a global marketplace, but operating with individual rules. And those indirect effects on China and Japan, the biggest thing that has on Australia is they're our biggest exporters of coal or minerals from Australia. So that's going to have, and a lot of those minerals are a big contributor to our GDP as well.
Yeah, so if they start to slow down, we will indirectly slow down because of that.
Yeah, for sure.
So, but that's probably the biggest effect that I've seen so far is, the e-commerce style shops that are Australian owned, manufacturing in China or elsewhere, and then shipping directly into the US, they are then subject to those tariffs, which then makes their product all of a sudden it's not affordable anymore. So they're buying locally. That was the whole purpose of the tariffs, I guess. But,
but didn't build any warehouses to manufacture anything before doing so.
Yeah, 100%. Have you seen the memes going around that China are creating at the moment? They're hilarious. They got like pictures of Americans in sweatshops building shoes and stuff. If you haven't seen them, go out and have a look. But I guess you got to really feel for these commerce stores or the e-commerce stores that have really built these massive businesses, and overnight, it's affected all because of this. And I really do feel for those guys.
And that's the thing with, and we didn't mention the ASX had a $71 billion capital loss over that week of tariffs,
which is mental.
Which in operating in that global marketplace and having a lot of not just money, but everything's susceptible to that global market. It makes sense why a stable, tangible asset like property is a safe, investment moving forward.
What some good news that came from that is the RBA have changed from being worried about inflation to now being worried about stimulating the economy, which is great news for homeowners or people wanting to purchase. What that generally means is rate cuts. So there's no two ways around it. We talked a little bit about rates, and we will talk about them more at the end, but rate cuts generally also mean that property prices will start to increase as well.
Correct.
So the stock markets, the share markets, all of that sort of stuff is quite volatile. And as we saw, ASX crashed overnight, lost, what do you say it was, $71 billion overnight. That's mental. That's literally from people panic selling. They news like this comes out, sell, always sell. That's how volatile the stock market is.
Well, there is, but when on an individual level, if someone goes, oh fuck, the market's tanking, I'm going to pull my money out of superannuation, that's taking liquidity out of the market.
Correct.
So it's
a sell-off.
Which is going to have an even bigger effect on
that's what
the
crashes
market.
a market. I remember seeing years ago a bit of a chart, and when markets are crashing, that's when people panic sell. But you should actually flip and do the opposite of what the general population are doing. In those situations, you should actually buy more. And I think that's where the things come out about Trump. He actually said, 4 hours or 6 hours before he announced the 90-day pause that everyone should buy. and then paused it, and all of a sudden everyone buys again, and that market just, all that capital is just back into the market. Everyone's converting their cash back into shares, and that's what's boosted the market overnight again. So that what we're getting at now is there a better way to hold your superannuation as opposed to just sitting it in these markets that we can see are so volatile? Should we be looking at self-managed super funds and holding your nest egg, if you want to call it that, in property as opposed to sitting in shares?
And that's the thing. Like we've all seen what a 10% tariff on Australia means, and then all of these other international tariffs that have indirect effects on Australia. What does it mean for the next four years that Trump's in office? What does that mean for the markets overall? So, property's always been one of those things where it's just a stable investment and a tangible asset for people, and there's 95% of Australians don't have exposure to residential real estate in their superannuation fund. So there's a big opportunity there.
Yeah, and you look at look. One of the main reasons I like self-managed super funds over industry funds is just the growth you're getting is on the value of the property, not the value of the funds that you held. So an example of that, let's say we'll just use round figures here, but let's say you had 200K plus costs, so let's call it 250. Now, in a decent fund, industry fund, what are you going to earn? Maybe 7% per annum?
Yeah, chuck it up to 10%.
10%, we'll call it 10. So that's about 25K a year in growth. In a good account. Now you convert that $200,000 and then you buy $1 million property, so 20% deposit plus costs.
Even say $600,000 property, which is really modest purchase.
Yeah, and then you use that 10% market growth property.
60,000.
You look at the difference between your 25 and your 60K, but it's also that capital, that compounding growth, that really kicks in at around that 10-year mark.
Yeah.
I did some modelling on another episode. If you haven't seen it, go and look at the self-managed super fund one. We did some modelling on that. A couple earning X amount, they had 17 years until retirement. The modelling between going with a self-managed super fund versus an industry fund with no extra contributions, it netted them an extra $1.5 million on retirement.
Yeah. But just from one purchase.
Just from one property at $600,000 over a 17-year period.
Yeah.
Versus leaving it in an industry fund.
And that's the thing. With that compounding nature of property in the fund, if you buy the $600,000 property, it continues to compound. Once you get to year 7, 8 or 9, you're extracting that equity and buying again, and then you have even more exposure to the market, and the compounding doubles.
And the setup of like getting a self-managed super fund set up and actually moving, it isn't as complex as a lot of people think. First step is just to work out, obviously, your balance. So most are going to require at least 150K balance. Anything lower than that, the purchase price is starting to get to a point where the setup costs and the management costs aren't worth it.
But I would just say 200,000 because you also want the property to be self-sufficient. You don't want any
huge contributions.
Yeah.
So it's not a huge outlay, and as you said, buying at getting it cash flow positive early is usually a bit of a goal, but it's that 10, 20, 30 year goal, like compounding growth that you get that really makes a difference.
Yeah.
So the first step of, if you are interested in getting this set up, reach out to one of us, send us an inbox. I'm happy to look at your current situation, see if it's suitable for you.
Yeah.
If it is, then we get the process rolling with a financial planner and accountant.
We can do a whole episode dedicated to structuring the self-managed super fund, but I think the biggest thing is just knowing that it's around that $200,000.
Yeah.
But the biggest thing is just there has to be a level of commitment. You have to be committed to meet with a financial advisor, meet with a mortgage broker, and then potentially talk to a buyer's agent. It's probably a month's worth of work to just have everything set up and go and execute.
You also need to accept it is going to cost you money to make money.
Yeah.
All these things need to be set up. You're paying for all these people's time, which is then going to create you a lot of wealth.
Yeah.
You're bitching and whinging about $10,000 now. I bet you're not bitching and whinging about the $1.5 million extra you're getting in 17 years.
Yeah.
It makes it really redundant. But that's the problem that a lot of people get in these situations is they get to the point of wanting to set this up and then they just shit the bed because it's too expensive.
Yeah.
Start thinking about the opportunity, not the cost right now.
It's just it's commitment. That's all it is.
So back onto some fun stuff. The rates, so the cash rate is currently sitting at 4.1%, correct? Yep. 4.1%.
Yeah.
So since all these tariffs and all these things have sort of come into play, the RBA has moved from being worried about inflation. Now they're worried about stimulating the market. The only way that they can actually do that is via interest rates.
Yeah.
As we've seen previously, they don't really make any other sort of policy decisions. It's just interest rates. So what most of the big four banks, they're actually predicting a further 5 rate cuts this year.
Yeah.
So further than what we've already had, which can take, a lot of them are actually predicting that the cash rate will come down to 2.85% by early next year.
Yeah.
So the reasons for that, as I said, inflation's not an issue anymore. Consumer spending has come down quite a lot, and there's a bit of uncertainty in the market as we.
Well, that's the thing. If we start having the negative GDP because of all of these indirect, not just Trump's tariffs, but those effects with Japan and China, that's going to absolutely hammer our GDP.
Yeah.
So they need to increase that somehow.
So if we then look at that in real figures, this is all just numbers to people, but the current, like a good rate, the good owner-occupier rate at the moment is about 5.85. 5.85. So it's less than 6%. If the cash rate dropped down to 2.85 from the 4.1, that'll land your actual interest rate at around 4.6, which is really good.
Massive.
So on a $600,000 loan, that's about $600 a month in savings.
And the average loan is a lot
It's a lot higher than that. 100%
So
it's a lot higher
that's
than that.
a super conservative figure.
But on top of that, what is going to happen as well is we all know banks love profit. So as these rates start really belting into the market, they're all going to start hesitating to drop as quick as each other. They're going to want to do half cuts because let's face it, you can't have a big four bank earning less than $10 billion worth of net profit. So they start to protect their margins.
Yeah.
So my biggest advice for people, if you do have a home loan, keep your bank accountable, ring them up, ask for pricing. If you're currently on more than 6%, ring your current lender and ask for a discharge authority. Really play the bluff. Your worst case scenario is they send the thing to you. It doesn't mean you're discharging.
Yeah.
Like they're not going to then cancel your loan.
Yeah.
It's just a bluff to get them to put you into their retention pricing, and then look. If they're not dropping, and I have seen a lot, especially with some of the big four banks, they've figured out that they can actually make more money by you paying out that loan and then them selling it to someone else at a better margin. So they don't do pricing.
Yeah.
So in that case, they're just saying, nah, you're on 7%. That's the best you're getting.
Yeah.
In that case, reach out to myself or a broker and get them to negotiate with other lenders for you. It's as simple as that.
Overall, the rates are going to have to come down.
Yep.
Because of this economic impact from our mate Trump.
Yes.
I think one thing before we wrap up that we didn't touch on is the potential impact this is going to have on the Australian dollar. And will that then incentivise foreign investors? I know there's separate laws that they've brought in and they're trying to block foreign investment. But if the Aussie dollar lowers, is that going to encourage foreign investment?
Possibly, yes. It's all got to be worthwhile to them, hasn't it?
Yeah.
If all of a sudden it becomes favourable, with the foreign exchange rates, then they will.
Yeah.
It's as simple as that. I think both governments are looking at limiting foreign investing to new builds only.
Yeah.
Which is obviously something we do need. So that could be a way forward as well.
There's coming up in the next episode, I've been researching recently about the state overruling a lot of local councils with rezoning laws. So there's
it could be a good next one.
Yeah, for just as a little heads up, most people's building heights are around 8.5 metres in building height for the standard R1, R2 and R3 residential zoning. And in some R3 residential zonings, they've increased those height limits up to 24 metres.
Yeah.
So that might be a good episode to pick apart.
So less red tape for building approvals, which is what we love. It's an absolute pain in the ass getting approval from a council.
Yeah.
But that's it for today. Thanks for joining, and we'll see everyone on the next one.
See you on the next one.